Hi guys, this is Renkat on Renkastar FX. So today I will be talking about Forex market and the types of transaction. On the last video, I talked about what you should know about Forex before you start. So if you are new to this industry, these videos are for you. Okay? So what is Forex market? First of all, Forex comes from the two words foreign exchange. Now, Forex market is an arena where nations' currencies is exchanged with that of another. Now, it is the largest financial market in the world and it has over 4 trillion US dollar turnover. Now, if you can compare it with 25 billion US dollar, a traded volume in New York Stock Exchange, you can see how huge Forex market is. Forex market has no physical location and no central exchange or off exchange. The market operates 24 hours, 5 working days a week. It is most often called FX market or spot market. Characteristics of Forex market. Forex market is characterized as follows. It is an electronic market. It is geographically dispersed, which means it is everywhere. It is an intermediary between one party and another. It also has a transfer of purchasing power, issue of credit through letter of credit, and minimization of risks. Functions of Forex. Forex functions in a transfer of funds, credit guarantee, and hedging. Now on hedging, some brokers allow you to place both buy and sell order on the same instrument at the same time. The structure of Forex market. How is the Forex market structured? The Forex market is structured in two market categories. The retail market, where we have bank and money changers, the currencies banknote and check, while we have wholesale markets, where we have interbank and the central bank. Now, what are the major participants? There are 4 major participants in Forex markets. 1. The retailers, traders and investors. 2. The commercial banks. 3. Forex brokers. 4. The central banks. And the commercial bank and the central bank and some of the financial institutions, they are called big guys in the industry. The Forex transaction. In a simple term, Forex transaction is an agreement between two parties to exchange one currency for another at an agreed exchange rate on an agreed date. It provides capital protection against unfavorable rates. And the nature of the Forex transaction: hedging to avoid loss, arbitrage to purchase currencies of 2 or more countries, and speculation and to price less and sell high, to buy deep and sell high, to buy the rumor and sell the facts. This is what traders and investors do using speculations in the Forex market. The types of transaction in Forex markets. There are 5 types of transaction in the Forex market. 1. Spot transaction. The spot transaction is when the buyer and seller of different currencies settle their payment within 2 days of the deal. It is the fastest way to exchange the currencies. Here, the currencies are exchanged over a 2-day period, which means no contract is signed between the countries. The exchange rate at which the currencies are exchanged is called the spot rate. It's often the prevailing rate in the market. The market at which the spot sell and the purchase of currency is facilitated is spot market. And the second type of transaction in the Forex market is forward transaction. A forward transaction is a future transaction where buyer and seller enter into an agreement of sale and purchase of currency after 90 days of the deal. Unlike spot transaction that takes only 2 days, the forward transaction deal is made at fixed exchange rate on a definite date in the future. The rate at which the currency is exchanged is called the forward exchange rate. The market at which the deals for the sale and the purchase of currency at some future date is made is called a forward market. Number 3 types of transaction is future transaction. The future transactions are called forward transactions and deals with contracts in the same manner as that of the normal forward transaction. But however, the transactions made in the future contract differs from the transaction made in the forward contract on the following grounds. Number 1, the forward contract can be customized on the client's request, while the future contracts are standardized, such as the features, date, and the size of the contract is standardized. Second, the future contract can only be traded on the organized exchanges, while the forward contract can be traded in any way depending on the client's convenience. The third, no margin is required in the case of forward contract, while the margins are required of all the participants, and an initial margin is kept as a collateral so as to establish future position. Now, number 4 types of transaction in the forex market is called swap transaction. The swap transaction involve simultaneous borrowing and lending of two different currencies between two investors. The obligation to repay the currencies is used as a collateral, and the amount is repaid at a forward rate. The swap contracts allow the investors to utilize the funds in the currencies held by him or her to pay off the obligations denominated in a different currencies without suffering a forex risk. Number 5, the last types of transaction in the forex market, which is called the option transaction. The forex option gives an investor the right but not the obligations to exchange the currencies in a denomination to another at an agreed exchange rate on a predefined date. An option to buy the currency is called the call option, while the option to sell the currencies is called as a put option. Settlement dates. Now let's re-examine or review the settlement dates of all transactions in the forex markets and understand their differences. Now you know that the settlement date is a security industry term describing the date on which a trade, bond, equities, forex, commodity, etc. settles. That is the actual day on which transfer of cash or assets is completed, and is usually a few days after the trade was done. Note that the number of days between trade date and the settlement date depends on the security and the convention in the market it was traded. For example, when settling a share transaction on the London Stock Exchange is set at 2 business days. On spot transaction can be 2 working days, or on the same day as ready or cash transaction. Also on tomorrow's settlement day, that is the next day settlement day. A future or forward contract settles at the specific futures date at a fixed price. Now the exchange rate. What is an exchange rate? An exchange rate is the rate at which one currency will be exchanged for another. It is the value of one country currency in relation to another currency. For instance, an interbank exchange rate of 114 Japanese yen to the United States dollar means that 114 will be exchanged for 1 United States dollar, or that 1 United States dollar will be exchanged for each 114 Japanese yen. In this case, it is said that the price of a dollar in relation to yen is 114 yen, or equivalent that the price of a yen in relation to United States dollar is $0.0087. Forex determination. What really determines Forex? So what determines Forex is the demand and supply. Demand for Forex. Demand for Forex in a particular country will be high when the country has larger volume of imports. For instance, when Nigerian people and business firms want to make payments to the United States for buying US goods and services or to buy assets there, the demand for United States dollar is generated. Supply functions in Forex. The supply of foreign currencies comes from its receipts for its imports of a particular country. When foreign nationals and business firms want to buy Nigerian goods and services or want to buy assets, supply Forex is generated. That means the needs for the supply of Naira to US and other nationals arises. Forex quotations. Forex quotation is the amount of currencies that is exchanged for a unit of another currency. For instance, exchange rates of Naira in Nigeria may be quoted in terms of United States dollar, USD to Nigerian Naira, which is equal to 410. These generate what is called currency pairs. Types of Forex quotation. There are 7 types of Forex quotation. Number 1, which is bid and ask price. Bid price is the buy price, while ask price is the sell price. The difference between two generates what is called a spread, and spread is what generates money for brokers. Second, direct rates. Unlike bid and ask price, direct rate is a constant rate. Number 3, which is indirect rate. Indirect rate is the price of 1 unit of home currency for an indirect quote. For instance, if Canadian dollar direct quotation now changes to 1 United States dollar to Canadian dollar, which is equal to 1.2700. Now the indirect quote will be 1 Canadian dollar to United States dollar equals to 78.74 cents. Others are spot rates, forward rates, and cross-currency rates. Factors influencing Forex rates. Factors influencing Forex rate are as follows: relative inflation rates, income levels, relative quality, relative interest rates, international trades, capital movement, change in price, speculations, strength of the economy, stock exchange operations, and political factors. So guys, with this piece of information I share with you in this video, I believe you have an overview about Forex markets and the types of transaction. More videos will be coming in, so if you enjoyed this video, please like, comment, and share, and most importantly, subscribe for more videos. Thank you. This is Renkat on Renkastar FX. Bye.